inflation data came in higher than expected. That's our topic for this morning's Backstage Pass. Stocks and mortgage bonds opened this morning sharply lower on the CPI report that was released this morning. The Consumer Price Index, which is a measure of inflation, showed that inflation rose 1.3% in the month of June. It was only expected to rise 1.1%, so a little bit of a hotter reading. And then year over year, inflation rose from 8.6% to 9.1%. As a result, like I said, the markets are reacting adversely as might be expected. Now, we're going to do a deep dive into some of the data, the internals of this report. So I'm going to throw a graphic up on the screen so you can kind of see what's going on the internals of this report. The core rate, which strips out food and energy, rose 0.7%, and that was also higher than forecasted. Year over year, core inflation fell 6% to 5.9%. Rents rose 0.8% last month and are now up 5.8% year over year. Energy prices rose 7.5% from a month ago, bringing the annual gain to 42%. Gasoline prices rose 11.2% last month and are up 60% year over year. Food costs climbed another 1%, and that brings the food cost year over year gain to 10.4%. And used cars were up 1.6% last month and 7.1% year over year. Now, this data will likely pressure the Fed to hike the Fed fund rate in their July meeting, which happens in a couple of weeks, by 75 basis points. But there is some talk out there, and the Fed futures has a 50-50 chance now of the Fed raising that by 100 basis points. So the Fed could be getting a little bit more aggressive with this hot inflation reading coming in. Again, like we said, the mortgage bonds reacted adversely to this news, and inflation is the enemy of the bond. Mortgage bonds prices dropped by 50 basis points at the open of the session this morning, but it kind of retraced its steps and made up some of the ground that it lost, and is down about 20 basis points on the day. The 10-year yield spiked to 9 basis points higher, but retraced its steps and is down or up only about 1 basis point at the time of recording. We do plan on seeing mortgage rates open worse today, as might be expected, but there could be some volatility. It just depends on how the market continues to first assess the CPI data and then try to predict what it thinks the Fed is going to do at the Fed meeting here in a couple of weeks. And so as the markets react to all of that, we could be in for some volatility throughout the day. Could see some repricing for the worse. If some of the lenders that opened their rate sheets whenever markets opened this morning, they could be repricing better because the mortgage bonds have kind of regained some of those losses. So we'll keep you informed as the day goes on. That's all the news that we have for you today. Remember to like, comment, and subscribe. And as always, stay positive. Hope you have a great day. We'll see you tomorrow.